One. And welcome everyone to another Smart Money Circle show. I'm Adam Sarhan. With me today is Jerry Parker, who's the chairman and CEO at Chesapeake Capital. Jerry, thank you so much for taking the time and welcome to the Smart Money Circle.
Thank you for having me, Adam. I'm looking forward to our conversation.
Likewise. So Jerry, you're a trend follower which is a fantastic world. I have a lot of questions I want to ask you, but I want to begin with your journey. How did you get to where you are today, please?
Well, I have a great journey story. Graduated from college in public accounting. I worked in public accounting for a while, knowing all the time that I wanted to get out of public accounting and do something more fun. So in my early 20s, I was studying, reading up on the markets and trading, and I stumbled across, some resources on trend following. This was back in the 70s, so there was no internet and no way to really do a deep dive on hardly anything. So, anyways, I was sort of interested in trend following. I thought it was a great idea. And hey, you take these small losses, and will the big profits pay for the losses, and then leave something for the profits? So I felt like, yeah, I really like this way of trading. It's objective, it's rules based. I like to preserve capital, and so from the accountant side of me, really liked the trend following strategy. In 1983, and Richard Dennis in Chicago was going to hire some people to teach him how to trade, give them money. He was a famous commodity trader, and I had heard about Richard Dennis through like a Business Week article or something, so I knew it was a legit deal. So I applied, took the test, got an interview, and got hired. I went to work there in Chicago in December of 1983.
Very nice. And where did you see the ad? Was it the Wall Street Journal ad, or did you see it somewhere else?
Yeah, it was in the Wall Street Journal. I think they said they ran it in the New York Times. They did it for 2 years in a row. I was in the first group. They sent everyone a true false test, and I think 1,000 people applied each year. And maybe interviewed maybe 30 people, and I was fortunate enough to get an interview. And like I said, I did well on the test because I just thought, well, hopefully this is about trend following. Hopefully they like trend following. So I sort of used that idea to guess a lot on the answers, and I ended up doing pretty well. So that was my kind of claim to fame to get the job, because there was people with much better resumes, and blackjack player, backgammon player, an actor. So they wanted to get a broad range of people who all, was reasonable intelligence. Because look, they're just going to teach you how to do everything with rules, so anybody should be able to do it.
Nice. And then question, how did you said trend following. For the audience, can you please give a broad definition or any way you want to define trend following? And then
Oh,
how were you attracted to that?
I liked it because it was rules based. So you have these rules. You take small losses and let profits run, and you're going to maybe have about 40% of your trades be winning trades. And I thought, okay, this makes sense. I thought it was something that was logical, and you just do a back test and to see if it worked, and see which parameters you needed for it to work. And we still practice that same strategy today. Lots of diversification is necessary and really benefits the trend follower, because you're waiting for these outlier trades. Try to hold on to your winning trades as long as you can until your system tells you to get out of the winning trade. But that's an uncomfortably long time period with lots of volatility and possible drawdowns in those winning trades. And then with the losing trades, you're going to make the losses small. And so the key to the whole strategy is to follow these rules, do the trades you're supposed to do, only do those trades. Interestingly enough, I think the biggest mistake everyone makes in the very beginning is you don't do the trades. You're kind of afraid. You don't want to take a loss if it goes against you. And so the first week or so of trading, after all the knowledge and the training that I had, I was still a little timid as far as pulling the trigger and just doing the trade. You just got to do the trade. You have the mechanism in place so nothing can go really wrong, which is you're going to take a small loss. But still, it just takes a while to get the courage up to do a lot of these trades.
So can you Yeah, I love that. So the trend following is you want to capture the
See what happens and follow.
got it. So for the trend following as a definition, you want to capture the bulk of the move, not pick the top or the bottom, and try to, when you're wrong, be wrong small. When you're right, be right big. That's essentially, there's lots of different ways to go deeper into trend following, but that's the essence of what it is that you're doing. Is that correct?
Exactly. And I just, for all these years, never really wanted to mess formula, screw that formula up by taking smaller profits or uh, things like that, and getting away from this one entry, one exit, and a stop loss. This kind of you know way to handle each individual trade individually with a breakout X entry or moving average crossover entry. And so you're just looking at each trade individually, trying to do the right thing on every trade, and then you add all those trades up, and that's your performance for the year or your career. And that's what's so important is you want to follow these rules and make these rules easy enough to where you're actually doing the same thing for each trade all the time for your whole career. So the British pound trade use the same parameters as the corn trade, but you're applying these rules the same way every single time.
I love it. So let's talk about the experience with the turtles because that's obviously one of the legendary, the one of the best stories out there from a trading over the last several decades, from a success story. And you said the idea was to take the trades. Can you talk about the actual experience when you moved there? How was it with Dennis and with William also, and anything that you want to share with the audience? Well, you saw some people fail. Why'd they fail? You succeeded. Why? And then anything else you want to share with respect to the your experience there?
I mean, it was a magical time, going to Chicago, living in the high rise. I came from Virginia. The Bulls drafted Michael Jordan. The sports were amazing, and the job was 7 to 2. So, and we learned from these genius people in the class, and then they gave us this money. They gave us this encouragement and this support. One of the things they would say, Rich and Bill Eckhart would say, like, just follow the rules, do the right thing, and don't kind of worry about performance so much. We're going to grade you on how well you implement these rules, which is how did I follow the system, not so much did I make or lose money. Eventually, you've got to make money. Eventually, you've got to say, hey, my system's not that good. But in this sort of learning environment where you didn't have clients complaining about losing money, you only had the one client saying, please follow the rules.
Right.
This was a great way to start. Not only were we given the rules, but we were given this incredible encouragement. After about 4 or 5 months, the whole group of us, 12 in that first year, had lost a ton of money, 30, 40%, and their response was, well, you're doing the right thing. You're following the rules. We're going to give you more money. And
Wow.
so that was sort of the bottom, and things took off from there in 1984, and then for the rest of those years. So, whereas most clients will say, "Look, I don't really care if you cheat and don't follow the rules, but you can make more money, then go for
Right.
it." So, in some respects, it's like giving a rule book on how to be a Marine. Here's the book. Here's how you're going to be a Marine, but you never go to the boot camp. Well, you're not going to be a very good Marine. In the same way, we had such a encouraging and pretend environment where we were given these rules and the support from these genius people who, for God knows why, would give us all these great ideas and tell us all their secrets and then give us the money. And then at the end of the 4 year period, we had a great track record and we could just go to Wall Street and sell our track record.
Hmm. So that's a fantastic story. I love that. The markets, let's talk about how they were trending back then versus how they've evolved over the years. And you still use a rules-based system now without going into the secret sauce. How would you explain the evolution of markets and trend following over the time? I know there's periods where it works great, there's periods where it doesn't, like any strategy. Can you speak to that a little bit, please?
Right. I think that's like any strategy, like you said, that's the way it's going to be. You just have to be disciplined and believe in your strategy enough to keep doing it. Number one, critical to that would be to trade a certain leverage and size to where you can withstand these long periods of not making money. Psychologically, it's going to be difficult. Trend following is psychologically difficult. 40% winning trades, a lot of small losses, profits turning to losses, buying the highs, selling the lows, getting beat up. Everyone knows what you should be doing. but you don't do it because you're following the rules and you look kind of silly sometimes. So I think the way the markets have changed over time, in a really good way, is that, like I said earlier, it's so critical to trade as many markets as you can with trend following, and the markets have exploded. We traded 20 markets to begin with. Now there are over 50, 60 commodities, the same in the currencies and interest rates. And we trade single stocks where there's thousands. So we can get a portfolio of hundreds and hundreds of markets, including these single stocks. And that just really is going to make the trend following perform much better, not go through as many droughts, have a more smooth performance. And you can still stick to the tried and true methodology without adding in other strategies in order to try to smooth out the performance. So we keep the robust strategies and a low because we're trading. We have a big drawdown somewhere, like 400 markets or 200 markets. So it's great. The profit was great, but the drawdown is going to be sort of inconsequential. The second most important thing I think that happened over time was the need to trade longer term. And back in the turtle days, we were trading very short term, maybe holding on to a winning position for a month or so. Now we hold on to winning positions on average for about a year in some ways. But then the markets, the increased diversification kind of makes up for that volatility and choppiness. And so I think those are the two main things. More markets to trade, take advantage of that. If you're a trader, trade as many markets as you can. Also, obviously, with trend following, longs and shorts are treated the same. We have no preference over longs or shorts. Shorts are really a superpower for your portfolio. And then, just if you look at some of these markets, the trends last 6 months, 9 months, or over a year. So that's what you kind of want to play for, not to get drawn into seductiveness of short-term trading.
I love that. So you said that the tried and true methods, which were originally taught to you by Bill and by Dennis. So the 20-day high, 50, that kind of thing, and 10-day low, entry exits, which is traditional turtle stuff. Are you still using that, or now that you're looking for longer term, do you adjust based on new parameters, and for individual stocks, whereas before you did futures? How does that work or come into play?
Yeah, you have to use larger parameters than 20 and 10. So maybe it's 175 or 150 and 100. You got to get up into the 100 range of these breakouts to stay out of the choppiness and get kind of whipsawed around. And you don't want to have a big trend. Look at the chart or look at the market and say, "Oh, that's a really big trend," but we didn't make any money because we kept getting in and out all the time. So kind of a backtest approach would help you sort of identify the parameters that walk that fine line of staying in when you have a big trend and maximizing that profit, but not staying in too long to where you give back too much profit. So that's sort of what we're paid to do is to know those range of parameters and trade in that particular way.
I love that. So next question, can you please tell us about your investment strategy? I know you have some ETFs and some mutual funds. People can look those up. But let's talk about the investment strategy, please.
So the strategy is, number one, to be trend following plus nothing. That's a little cliche we came up with. We're trend following plus nothing. We don't add anything to our trend following. No other strategies, mean reversion, pattern recognition, carry, short-term trades, none of that stuff to smooth out the trend following. I don't think the trend following needs to be smoothed out. Everything is going to detract from performance. That you can't improve the trend following with any of those other methods. It just is a way to make people sleep better at night. Mainly the manager, I think, to feel better. I think clients want to know when they put trend following in their portfolio, it's going to really perform well when they most need it. And if you kind of water down the trend following with these other methods, or some people have methods in there where they take profits on the way up, that is something we try to avoid as well.
Got
And
it.
then, like I
Oh,
said earlier, we trade lots of markets. We were really big. We trade more stocks than anyone. I don't think there's another CTA out there that trades single stocks in their trend following strategy. And we do that. It's just such a much better alternative than stock indices. You get more diversification. You get more chance for these outlier moves versus an index. And then another thing that we're kind of known for is this one entry, one exit, and a stop loss, where we're only using these more simplified ways of handling these trades and making sure we get into a trade and not ever missing a big trend, and then only getting out when the trend reverses. One of the theories of trend following is that you can't predict where these markets are going to go. I know the trades get scary. I know they get volatile. You have to man up and hang into these trades. Whenever you do a back test, or just anecdotally even look at past trades, you'll just notice that the human tendency is to get out quicker. People want to take that loss, take that profit as quickly as possible. They're very fearful that they're going to give back too much profit, and they should be fearful that they're going to leave money on the table and get out too quickly.
yeah, that's a really, really good point. Where in other words, you're going to miss the big upside, and because you took a small gain of 5%, but you missed the next 20 or 50 or whatever the case may be.
That's right. If you take a situation like cocoa or recently coffee or short the yen, these are big trends. They've lasted a long time. The market is doing all this heavy lifting for you and making you all this money. The only thing you have to do is don't screw it up. Don't get out too quickly.
Yeah.
You've got to follow your systems, but I think sometimes the systems are too short term and have too many bells and whistles that essentially all they're doing is helping you get out quicker to make you feel better. I think traders should sort of seek out pain and suffering, not use comfort and pleasure. It's not only do the right thing, it's do the hard thing. The things that work in trading are going to be hard to do psychologically. They're not going to be fun. This type of trading takes years off your life. It doesn't. It's not. It works because it's hard. It's going to keep working because it's hard for people to do it.
I love that. Do the hard thing. So I wrote a book behind me. It's called Psychological Analysis. When you speak about the psychology stuff, I light up like a Christmas tree. And the book was number one on Amazon for 3 months. Everything you're saying, I mean, this is our first time meeting and speaking, but I've experienced in a similar way in my own journey over the last several decades. And I love what you're saying because it's so right.
Well, congratulations. I looked at your book. It's in my
Thank you.
Amazon cart, so I'm looking forward to reading it. One of the things that got lost in the turtle after the turtle program, when everyone went out and started raising money, and then podcasts and interviews and things like this, was that part that Rich really emphasized, which was not part of the rules and not objective. It was very subjective, and that was mixing it in with the trend following rules, these ideas of contrary opinion. So
Mhm.
if the market, if you felt like the news or the market was getting too one sided, too bullish, then you should be very concerned about that and maybe use some discretion to exit your position quicker. And a lot of the turtle rules did revolve around this idea that you should prefer markets that have been very bad recently. Like you've had, it's been a long time in a certain market since the market has trended. A lot of false breakouts, a lot of consolidation. The volatility is low. People hate this market. They don't want to trade it any longer. All it does is produce losers. And this is cocoa, right? And cocoa had never made money really. And kicking it out of your portfolio would have been a logical thing to do, but not from a hardcore trend follower point of view. You want to keep all these markets in there because anything can happen in the future, the things you least expect happen. That's when trend following does really well.
Yeah, I love that. That's a really, really good point. It's almost like after every red light, there's a green light, and vice versa. So if you ignore the red lights, you're going to miss the inevitable green lights that follow the big uptrends.
Right. That's really the key is not missing these uptrends. The first big trade in the turtle room was January, right out of the gate, January 1984, and it was heating oil, Feb heating oil, and it sort of doubled, tripled in price because there was a frozen harbor in New York, and they couldn't get the heating oil in. And it wasn't January heating oil, it wasn't March heating oil, it was Feb heating oil. It was the only one, and really skyrocketed. And I have to tell you, so few people in the room, right out of the trading class, did that trade, didn't even do the trade. And that's why when people say, I think exits are more important than entries, I'm like, exits are important. There's no reason to think of one more important than the other. But look, if you don't put the trade on at all, which
Yeah.
half the room didn't even do, then as a trend follower, you're missing a trend sacrilege. You're not going to get many of them. And if you talk yourself out of a trade, it's probably going to be the one that's going to make a lot of money.
Yeah, I couldn't agree with you more. That's so, so powerful. There's almost like there's multiple errors. There's a, low level error, and then there's a higher level error. Missing those big uptrends are definitely a bigger error than most people even, they don't even think about that. It's not even part of their conversation.
It shouldn't even be a question. You have a fail-safe mechanism. Take a small loss.
Yeah.
It's inconsequential to do this trade. If it is, you're trading too large or you don't have enough markets. And then what similar fail-safe method do you have if you don't take the trade? Nothing. You have
Yep.
nothing.
Yep.
I don't think
Yep.
taking profits was, I'm sorry, I don't think taking losses was ever a problem for me. It was one step further. I didn't want to do the trade in anticipation that I would take a loss.
Hmm.
And so that's what you have to get over. And the first phone call I got from Rich, he asked me, like, how many trades do you think you should have done this week? And I said, they're probably like 10. He goes, how many did you do? I said, like one. He goes, yeah, you got to take those trades. And so that sort of response to such a stupid error on my part, encouraging, not condemning, that's a big part of Turtle success is being with those guys for 4 years.
I love that. Now, let's talk about that for a second. You said that internal conversation of not taking the trade. So you're talking yourself out of it, whether it's fear or it's whatever, enter any other reason you want. How do you
Yeah.
overcome that? What's the solution there that you've learned?
Well, one of the solutions to trading, or one of my pet peeves of trading on Twitter, let's say, and maybe, no offense if you've said this, I guess we can just disagree, genuinely disagree on this, but I really don't like this statement of a person should trade a system that's good for them. You have your system that's good for you. I have mine that suits me. Because if you're not going to do the system, if you're not going to follow the rules, if you personally can't follow them, then what good is it? So you have to come up with a strategy that suits your personality. So I think that that's dangerous. Um, I think trading is hard. Trading, you have to stick by these rules. Not all your rules and what suits your personality is good for you. It's not going to work out for you to take small profits and take large losses, but that suits my personality. I'm sorry. So I think, right, I think the first rule is then don't trade. Trading is not for everyone. If you can't do it, don't waste your money and lose money by trading a system that suits your personality when your personality is really not suited for trading. Um, but then over time, if you eventually do become suited for trading and you've gone through the mistakes and the pain of losing money, then that's teaching you not to do that again, right? So I think thankfully for me, anytime I deviated from my system, it never worked out for me. I never had like luck that said, oh, look at that. You got out early or you didn't do a trade and look how much money you saved. Well, thankfully, I lost on those all the time. So I had, anytime I was tempted to do that, it was really close in my memory to, that how painful that was for me. So I think really it's just through going through the motion. You're gonna make these mistakes. You're gonna have to pay this tuition to the market, and so pay it as small as possible. So when you first start trading, Rich would always say, just trade small. That's one of the most important things to do. Um, and of course, we had to sort of juxtapose that with the fact that we were trying to make 200% a year, and we had, and so there was some politics in the room, like trade small, follow the rules, but if you use some discretion, you may get rewarded, and we're expecting you to make 200% a year. So we kind of had to navigate and figure out how do we do both, and so yeah, that was quite a challenge.
I love that. So let's talk about risk. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
Well, I think with trend following, the risk parts and the money management, the capital preservation is all in this one big soup wrapped up with making money as well. So Sometimes I don't know if we're making money, if this part of the system is about making money or about preserving capital. It's kind of about both. So once again, massive diversification, hundreds of markets, great for diversification, great for preserving capital, and you're going to hit more trends, more long-term trends, and you're going to be able to hold on to trades longer and not get freaked out by a big drawdown in any one market because it's one out of 100 markets or 200 markets. So I think that's very important. Uh, Taking the small losses, critical. You want to take those small losses, make these small bets in every market, and if it goes against you, it's sort of inconsequential. The loss is very critical. I think one of the things that you want to do as it relates to capital preservation and risk control is to get it squared away up front before you trade. Don't think that you're going to get down the line somewhere. You're trading too large. You're not taking small losses. You don't have a very diversified portfolio, but somehow you'll come up with some rule that reduces risk very quickly and saves your butt. So I want to have all of this squared away up front where I'm trading lots of different markets and I'm taking these small losses. My bet size is really small per trade. And so the odds are just tremendously in my favor that I'm not going to have a problem. And we're going to separate my capital as well. I've got the capital part, the $1 million that someone gave me to manage for them. And then I've got the open trade part. And I'm going to let those open trades fluctuate violently, crazily, because I'm sacrificing all of that to the altar of following the rules. And the rules are unwieldy. And if you just sit there and follow your rules, entry and exit rules and your stop loss rule, who the hell knows what can happen? You can have a lot of volatility, a lot of profit give back, but it's all in that category of the the open trade equity. And with the closed trades equity, where I've just got the P&L trades and the original capital, that's the number I'm using for my trade size. So I'm just going to risk that capital put that into my formula of how much capital I'm willing to risk per trade. I'm not going to use the capital, the money in the open trade profit as if I have already earned that and it's stable. It's fluctuating daily and wildly. So I think that's one mistake that people make. They use the total equity and they end up trading larger based upon momentary profits that they have that can go away. Then all of a sudden, yeah, they're trading too large. So if I start the year with $1 million in my account and I run it up to $1.5 million during the year, I'm going to size my trades throughout the year at the $1 million level for the entire year, or maybe even longer, because I don't want to watch to put on these. And the trades are very different. You know, you got some trades that you did in January, some that you did in June, at vastly different sizes. So to some degree, that's treating the trades differently and not really following that disciplined approach of trying to treat every trade the same way. So I think that's a critical area that I've really not heard anybody adopt that methodology that we learned in 1983, is to really concentrate on your capital account and so you're able to allow those profits to run and you're able to follow those rules.
Yeah, that's really smart. So you have open P&L. You're not going to focus on that. You're just going to look at the basic principle. Where were we? What in size accordingly? Because if those open profits go away, then you're down much bigger. You're get much larger.
Right.
Yeah.
You're overtrading.
You're overtrading.
Yeah. Because what about, you can't trust these open profits. They don't behave.
One of my favorite, Jerry, you can appreciate this one, business mottos. This came from an author, great book. He goes, "It don't mean a thing unless it goes ka-ching." I think that was Jeffrey Fox. It's a great line. So until you're actually out of the position and you've locked in the money, that it doesn't mean anything.
That's right. It does, and it shouldn't mean anything. And don't let it mean something. I think that's psychologically what happens. People let it mean something. I know when I first started trading, I was poor. You know, I was making a small salary and living in a small apartment. And then after a while, you're making money, that you start thinking of all the things you can buy. And I think really divorcing that money piece from just the game part, make it a game. And the game is to follow these rules. You've done this back test. You're very happy with the back test. And the back test basically says, if you follow these rules for the rest of the year, for the rest of the rest of your life, you're going to be very happy. So try not to concentrate on the thing that's the most important thing in everybody's mind. I mean, that is the current trade. We're all obsessed with the current trade we're in. We don't want to, in this current performance, what are people going to think if I don't make this money, if I give back too much profit? And so you have to divorce yourself from what's going on now and currently to sort of say, you're playing this really long game. You're going to be number one in the future. You'll be very happy with yourself at the end of your career if you were able to follow all these rules consistently, never deviate, which nobody can really do, but you can try to do it. And so I think this is one of the keys to, and you can get there. People can get there. You don't think you can. I lost 65, 70 pounds one year in 1999, and I'd never
Wow.
lost weight before. You don't think you can do these things, but it's one foot after the other. Each day you get a little bit better. Each day you practice. And that's the same with trend following. You just got to practice. And when you're starting out and you're not very good, just trade small.
Yeah, it's like building a muscle, right? It does take time. Congratulations on that weight loss. That's awesome. So I do have a question for you. You said to ignore the profit, not ignore, but divorce your emotional attachment to the profit. So you started at the million at the beginning of the year. You ran it up to 1.5. You're still going to trade based on a million. Do you reset that at the end of every year, or is that reset at the end of the quarter, or how does that work? Is the first question.
Yeah, I like to reset it when, materially, let's say in this example, you go from a million and you run it up to the end of the year uh, at 1.5, and then sometime in the first quarter of the next year, you all those great trades where you made 50%, they kind of go away. They're all kind of done, but you ended up making 300,000. So now you're at 1.3. So maybe that's your new trade level, 1.3. So when every now and then when you P&L out a lot of trades and you have a big bump up in your capital and very little open trade equity, absorb that new equity and in a responsible way and go forward with that. And so I think that is a way to ensure that the whole trend following thing is going to work well for you. I think most traders do nothing like that at all. They incorporate all those open profits on a daily or monthly basis, readjust the positions based upon this, and then they have to scramble. Like we have a really bad period. What are we going to do? Start getting out of trades,
Right.
which is good for money management reasons, but we've already stipulated up front. Our goal is to not have to do that. We may have to do it even ourselves. Things that get hairy and bad, and we may have to do that ourselves, even though we've exercised great restraint on increasing our trading size. But we may have to do it too. But I think you don't want to get into a situation where you really have to scramble and you have to get away from doing the system trades. Nothing is going to do as well as just following those system trades. Any sort of discretion and over doing it on the money management side, it's not a system trade. It's not wrong to do it necessarily. It's just you're not being consistent and doing the same thing with each trade.
I love that. How
I
about
want,
on the down? Sorry, go ahead.
I want to get out of my British pound when it hits the 100-day low. I don't want to get out of it because I'm losing too much money. You may have to, I just don't want to. And so responsible diversification, responsible leverage from day one, responsible calculation of the trade level. All of this goes into the very beginning of your trading, uh, not later when you realize that you're really over trading.
So it's a brilliant point. And what about the downside and drawdowns? And let's talk about that because that happens to everybody. You said you're not going to adjust that level. You'll be at a million, you get to 1.5 million when you have a profit and things are great. You'll adjust it next year. How about let's say you're at a million, you drop to 900,000. Are you going to put on trades based on a million? Or are you going to put on trades based on 900,000?
That is a really good question, and I'd never get asked this question, but it's a great A plus for you asking
Thank
that
you.
question.
Thank
Yeah,
you.
no, it's a great question because I think everybody's waiting for this answer, right? Um, right. I think that I would put that trade on based upon a million, and I would have a cutoff. Let's say maybe it's minus 20%, where I would have to readjust and make my trade level 800,000. But yeah, so I'm going to try as long as I can to keep that trade level constant on the upside and on the downside. One of the things that tickles me a little bit is I hear people say all the time that if you're down 50%, you have to make 100% to get back to break even. Well, kind of the way we do it, you don't really have to, because you're kind of trying to trade the same level all the time, and the same risk and the same size trades all the time. But at some point, you do have to bite the bullet and realize, hey, I need to cut back. And that particular scenario is relevant primarily when you first start trading. But as you get going and you start getting into the trend following flow, taking these small losses and letting the profits run after about 6 months or a year, your capital is not going to drop below that million. And if you do a back test, we've done these back tests, lots of these back tests, and we've never seen a situation in history where the drawdown in the capital exceeded the open trade equity.
Oh,
So to some
wow.
degree, yeah. So to some degree,
Wow.
you never see a drawdown in your capital. Now, this is Jerry defining capital in a very unique, goofy way that no
I
one
was going to
else
say,
needs to like
right,
or agree
right.
with. But that's pretty amazing with these long-term trend systems, with hundreds, at least 100 or 200 markets in it. The open trade equity has historically always been greater than your closed trade equity drawdown, your capital drawdown. So I don't tell that to clients, and I don't really make a big deal about it. But you ask a good question, and once you get through that first initial stage of 6 months or a year, and you start building up the open trade profits, they really do exceed any issues you have with the capital.
I love that. Well, thank you very much. Because handling drawdowns is, in my opinion, one of the most important. It's like a superpower. It's one of the most important things because if you can do that gracefully, you'll be in business for the rest of the time, like you have for decades. But the ones that get in trouble, they blow up. They don't handle the drawdown. They get in trouble and they're gone. I always like to joke around. People, well, I'm serious, but I joke around. People come into the market only looking at the reward side of the equation. They don't even look at the risk side. Most people,
Yeah,
at
but
least, and then they
I
just
don't
get
think
blown up.
Yeah, but I don't think most people would agree with me because they would say like, what do you mean you're not going to pay attention to this open equity? It's mark to market. This is our money. We could get out right now and have this money. And it's very painful. And if you want to go to clients and say to them, oh, we've had this big drawdown, but trust me, it's only in open equity, not in closed equity, they would say, what the hell are you talking about? This makes no sense. This is
Right.
all of our money. And I'm like, okay, I get it. I need to do this mathematically and psychologically to maximize my profit in the future, not today's profit, not mitigate this particular drawdown, but for the whole career, for the whole lifetime of this trading. And equally as important, the only way for me to do that is to follow these systems perfectly to a T and never deviate and exit my trades when their exit gets hit and not for some goofy money management reasons to that essentially are just preserving profits and psychologically not wanting to have to deal with the guilt and their clients of giving back too much profit. But if you're going to follow you don't want to manipulate your rules to where they will not allow you to have a bad period. And I think that's what people want to do. They want to come up with more rules. We'll just keep writing rules until we don't have the drawdowns that we don't want to have. And then we're following the rules.
Right.
Well, you've got a lot of bad rules there. And the rules that I like are the ones that you can't control. They're going to potentially put you in situations where it's going to be a nice drawdown that you're not going to like. The only problem is those rules make more money and they're better at preserving capital.
Yeah, no question, because it's over the long term. Like you said, I love that your line was people are obsessed with the current trade. They're obsessed with their current P&L based on, you were saying day to day or month to month, you're being nice. I think most people today look tick by tick or second by second
Yeah,
with their P&L.
right.
All right, next question for you. Timeless lessons you've learned along the way that you'd like to share with the audience, please. You can go in anywhere, any way, shape, or form.
Oh, I've mentioned them all pretty much so far. Trade small, um, follow the rules. I think those are the two most important things. And sometimes they kind of mix together. You know, if you trade too large, you can't follow the rules. I've been in that situation before as well.
So am
Uh,
I.
yeah, I think
Yeah,
it's so difficult. Yeah, it's so difficult to stick with it and not think you need to make changes. Uh, we we made some changes, and oh yeah, we made some bad changes in 2006. I think we were making these changes, and it was getting away from because we heard what other people were doing, and we had a lot of success, and we're like, let's improve ourselves. I was listening to somebody today saying that one of Tiger Woods' major problems was he started using too many golf coaches. And you can kind of listen to what other people are doing and change and evolve. But if you start getting away from your core strategy, like trend following, you're really going to regret it. And we got away and we started trading. And then after 2 or 3 months of changing our systems around, we started seeing performance that we had never seen in the back test. And that's a really bad idea. And so we all of a sudden swore off these bad ideas. We went right back to where we were. And I think people love to do research and learn and evolve. But a lot of research that people do is bad research, and it really you sort of zig when you should zag. Um, and change has its own cost. I know another time we made some minor changes after 2012. We had some underperformance in 12, so we wanted to stick with the basic rules, but make it a little bit more able to reduce our risk in certain areas in certain ways. And these were good changes. And I went into the research department and I'm like, are you guys ready to implement these rules? And they said, yes, but the old systems are outperforming these new systems.
Right.
And so we were like hesitating to change because, and that inevitably is going to happen, you know, when nothing was broken, it just went through a bad period. That's really something you have to really understand is should I change or should I not change? There's cost, you know, because look, what's the key? Be consistent. Why do you have to be consistent? Because if you're consistent, when you least expect it, what hasn't worked will start working.
Right.
So if you switch, you know, there's a cost to that. You could switch right into doing the wrong thing.
Love that. So, next question. What's the best piece of advice you'd like to share with the audience or your 30-year-old self?
Oh, wow. uh, hmm. I've said everything. I think trade a lot of markets, trade stocks. That is kind of a baffling thing to me. I remember sitting in the turtle class in trading and hearing all of this about diversification. So then when I went out on my own and I could do what I wanted to do as far as markets and stocks, I was like, look, for us right now, if we want to get massive diversification, we're going to have to trade a few stocks. So why don't CTAs use stocks in their trend following? That baffles me. I really don't understand. It's just a way to improve. You know, you should always try to seek to improve your methodology. I'm big into marketing. I'm big into, I love reading marketing books. The best marketing book I ever read, one of the chapters was improve your product. That's the best thing you can do. And I was like, yeah, you've got to always try to push and make it better for the clients, which is going to be better for us. I'm always asking myself, how can I make trend following better? How can I show what it can do and how it can maximize its ability and its effectiveness? And one of those is actually practicing trend following and doing it over as many markets as possible. I would love to trade the commodity markets in China, and I hear about other CTAs that don't trade stocks into a lot of other over-the-counter swaps and exotic markets that I can't trade. I'm jealous of that as well. I would like to trade 700 markets, not just the 400 we have in one of our ETFs. Oh, and I have to correct myself. I'm not supposed to say markets. I'm supposed to say instruments and securities and
Okay.
futures and assets. So
Right.
forget all those market comments. But yeah, so I think trying to make things better for the client and for yourself and to make performance better is an unending practice and it's something you should strive for. And of course, you've got this other thing that we've already talked about, which is doing too much, getting too far away, getting away from the core of what is good about your strategy, especially trend following.
No, I love that. So a few months ago, I had Cole Wilcox on. He's the guy who wrote the paper 20 years ago about
Yeah,
does trend following work for stocks? Yeah, great
right.
guy. And
Yeah.
I'd like to talk about that because you mentioned stocks. I know a lot of people like trend following in stocks, but I've heard, I don't know for sure, but that traditional turtle program, the rules that turtles had initially didn't work for stocks. That's why Dennis and Bill were primarily futures, not stocks. I know you've made your own rules that work, but how can you speak to that and why there's confusion or some people have a hard time applying trend following to individual stocks, please?
Well, I love that podcast. I listened to it. I think I tweeted
Thank
some
you.
statements from it. I love
Oh, nice.
Cole. I've seen Cole recently in my hometown, and I met him a long time ago when he was first starting out. That paper is amazing and wonderful. I am the biggest practitioner, one of the biggest practitioners of actually doing what that paper said. I think maybe, yeah, there was no ever any chance that the turtles would trade stocks regardless. I don't think there's anything to this idea that trend following systems that work in futures don't work in stocks. I think it's quite the opposite. Stocks usually over the past 10 or 15 years have been the best trenders out there. And we see a lot of great trends in stocks now. Everybody's aware of NVIDIA and some of the big names out there. These stocks are really good for trend following. It could have been a situation that stocks from the get-go needed to be longer term than trend following. So like I said, back in the 80s, we traded shorter term, and it probably never would have worked for stocks. But now that all the CTAs are pretty much trading these longer term breakouts and moving average crossovers, those sort of parameters work well in equities as well. I think the reason that there's not more equity trading is it's not proper in the managed futures category to trade equities. It's only futures and maybe some FX markets as well. But that's why I don't want to be known as managed futures. Trend following is bigger than managed futures. It cannot be held back and restrained because clients of managed futures don't want individual stocks. That's ridiculous. That's what I'm trying to do is blow that whole thing wide open and say, let's put trend following first and maximizing that portfolio and the wonders of that and how wonderful it is to have this strategy that is very reliable, that preserves capital and makes good money. And we do a lot of long stocks and short stocks in our funds, and it's strictly 100% trend following with the same systems as because a lot of the larger CTAs they do trade a lot of stocks, thousands of stocks I've heard, but not in the trend following strategy. The clients don't want it, and that's why I don't have those clients. I have retail clients who, if they trend follow, they're probably trend following stocks. We have a lot of people who love trend following. That's a perfect client for us. They understand it. They love it. They do a little bit of it on their own, primarily in the stock market, and then we fill in with the futures, currencies, commodities, and interest rate futures as well.
Beautiful. Well, Jerry, this has been absolutely fantastic. Thank you so much for taking the time to speak with me today, and hopefully we'll have you on again soon.
I look forward to it. Thanks for having me.